Don't trust the bank with your cash. Trust these 7 assets instead. Have you checked your savings account lately and felt that sinking feeling watching your hard-earned money basically standing still while inflation races ahead? I used to think banks were the safest place for my cash until I realized something troubling. Keeping most of your wealth in traditional bank accounts is actually making you poorer every single day. What if I told you that the financial institutions we've been taught to trust are actually designed to benefit from your money while giving very little in return? Most Americans diligently deposit their paychecks into savings accounts, earning pitiful interest, watching their purchasing power quietly erode year after year, not realizing there are far better alternatives hiding in plain sight. Here's something the banking industry doesn't want you to think about. When you deposit $10,000 in a typical savings account earning 0.5% while inflation runs at 3 to 4%, you're effectively losing hundreds of dollars in purchasing power annually. That's not protection. It's a slow financial bleed. I discovered this harsh reality myself after keeping a substantial emergency fund in a high-yield savings account for years, only to realize it had lost nearly 20% of its real value over time. Today, I'm going to share 7 powerful alternative assets that smart money has been quietly shifting toward. Tangible, accessible options that offer both protection and growth potential for your hard-earned cash. These aren't exotic investments requiring massive wealth or special connections. They're practical alternatives available to everyday Americans who simply want their money to work harder and smarter in today's economic reality. By the end of this video, I'll reveal the single most important wealth preservation strategy that financial institutions hope you never discover. A straightforward approach that could completely transform how your money performs over the next decade, while protecting it from both visible and hidden risks lurking in the traditional banking system. If you're tired of watching your savings barely tread water while inflation chips away at your financial future, type PROTECT in the comments. Let me know you're ready to discover these powerful alternatives to traditional banking. Now, let's dive into the first asset that could revolutionize how you think about storing your wealth. Asset number 1, I-bonds, the government's best-kept secret. Have you ever wondered why financial advisors rarely mention series I-savings bonds? It might be because they can't earn commissions by selling them to you. I-bonds represent one of the most powerful cash alternatives hiding in plain sight. A government-backed asset specifically designed to protect your money from inflation while offering tax advantages that banks simply can't match. This might be the closest thing to a perfect cash alternative for the average American seeking both safety and inflation protection. What makes I-bonds particularly valuable in today's environment is their unique dual-component interest structure. Unlike traditional savings accounts with fixed rates, I-bonds combine a small fixed rate with an inflation-adjusted rate that changes every 6 months based on consumer price index. This means your money automatically keeps pace with inflation, precisely what bank deposits fail to do. When inflation rises, your I-bond returns rise with it, creating a protective shield around your purchasing power. What many people don't realize about I-bonds is their exceptional tax advantages. The interest is completely exempt from state and local income taxes, a significant benefit for residents of high-tax states. Additionally, you can defer federal taxes until you redeem the bonds or choose to report interest annually. Flexibility no bank account offers. For education expenses, the interest may even be completely tax-free under certain conditions. There are some limitations to be aware of. You can only purchase $10,000 per person annually through Treasury Direct, plus an additional $5,000 using tax refunds, and you must hold them for at least 1 year. Redeeming before 5 years incurs a small penalty of 3 months' interest. But these minor restrictions pale in comparison to the benefits for money you don't need immediate access to, particularly emergency funds or saving for known future expenses like home down payments or education costs. The process for purchasing I-bonds has been simplified to the Treasury Direct website, making them accessible to anyone with an internet connection. Yet most Americans have never heard of them or misunderstand them, because the financial institutions that normally educate consumers about financial products have little incentive to promote assets they don't profit from. Now, let's explore our second powerful bank alternative, which offers both protection and growth potential. Asset number 2, gold and silver, time-tested wealth preservers. Have you noticed how often financial experts dismiss precious metals as primitive or outdated investments? This dismissive attitude might explain why so many Americans were caught unprepared during recent currency devaluations and banking uncertainties. Physical gold and silver represent mankind's longest-standing wealth preservation vehicles, assets that have maintained value through wars, depressions, currency collapses, and every other financial calamity over thousands of years. Far from being outdated, they may be more relevant than ever in today's increasingly unstable financial landscape. What makes precious metals particularly powerful as bank alternatives is their complete independence from the financial system. Unlike virtually every other asset class, physical gold and silver held in your possession require no counterparty to make good on a promise. They cannot be devalued by excessive money printing, cannot be frozen during banking crises, and cannot be depreciated to zero like failed currencies throughout history. This unique characteristic makes them an essential component of any comprehensive wealth protection strategy. I remember meeting Maria, who emigrated from Venezuela with her family's wealth largely intact despite the country's catastrophic currency collapse, because her grandfather had consistently converted a portion of family savings to gold coins. While our neighbors watched their bank balances become worthless despite showing millions in their accounts, our gold maintained its purchasing power, she explained. It wasn't an investment for growth. It was insurance against systemic failure. Insurance that unfortunately paid out. The modern case for precious metals has strengthened as governments worldwide have embarked on unprecedented currency creation, driving concerns about long-term purchasing power. Many central banks themselves have accelerated their gold purchases to record levels in recent years, actions that speak louder than their public statements about monetary stability. These institutions understand gold's role as a hedge against their own policies. For practical implementation, most experts recommend allocating 5 to 15% of your wealth to physical precious metals, focusing primarily on recognized gold and silver coins rather than collectibles or numismatics. Proper storage is essential. Options range from home safes for smaller amounts to private vaulting services or allocated storage programs through reputable dealers. Whichever approach you choose, proper documentation and insurance are crucial. The most common objection to precious metals, that they don't produce income, misunderstands their fundamental purpose. Gold and silver aren't meant to replace productive investments, but to serve as wealth insurance and monetary alternatives outside the banking system. They represent money itself rather than investments denominated in money, a crucial distinction in uncertain times. Their purpose is preservation first, with appreciation potential a secondary benefit that has historically matched or exceeded inflation over long periods. Let's explore our third powerful alternative, which combines safety with passive income potential. Asset number 3, dividend-paying whole life insurance. Have you been told that buy term and invest the difference is the only sensible insurance strategy? This widely repeated advice overlooks one of the most powerful cash alternatives used by banking institutions themselves: properly structured dividend-paying whole life insurance from mutual companies. While most financial media dismisses whole life insurance as an expensive investment, they're missing its unique role as a cash alternative that offers safety, growth, tax advantages, and accessibility features banks simply cannot match. What makes dividend-paying whole life unique as a bank alternative is its combination of guarantees and participation in company profits. Unlike term insurance that simply expires, these policies build cash value with both guaranteed growth and non-guaranteed dividends that have been paid consistently by top mutual companies for over 100 years, through every financial crisis, including the Great Depression. This cash value grows tax-deferred, can be accessed tax-free through policy loans, and provides a death benefit that passes income tax-free to heirs. The key distinction most people miss is that not all whole life insurance is created equal. The specific design makes an enormous difference in performance. Properly structured policies from mutual companies, where policyholders are the owners, maximize early cash value growth and long-term returns by minimizing the death benefit relative to premium while utilizing paid-up additions riders. These specialized designs function very differently from the whole life policies typically criticized in financial media. What makes this strategy particularly powerful is a unique access to capital. Policy loans allow you to utilize your cash value, while the same money continues earning dividends uninterrupted, effectively allowing you to use the same dollar twice. This feature makes properly designed whole life insurance particularly valuable for business owners, real estate investors, and others who need capital efficiency and liquidity combined with growth and safety. The banking industry understands this value proposition well. Major banks hold hundreds of billions in cash value life insurance as Tier 1 capital on their balance sheets, essentially using the same financial tool I'm describing to store their most important capital reserves. This bank-on-yourself approach allows you to create banking functions within your own financial ecosystem rather than depending entirely on external institutions. Now, let's examine our fourth powerful alternative, which provides both income and inflation protection. Asset number 4, income-producing real estate. Have you noticed how many wealthy individuals prioritize income-producing real estate in their portfolios? This isn't coincidental. While most Americans limit their real estate exposure to their primary residence, income-producing properties represent one of the most powerful alternatives to bank deposits, combining inflation protection, cash flow, tax advantages, and leverage potential that traditional banking products cannot match. This tangible asset class has created more millionaires than perhaps any other investment vehicle and remains accessible to average Americans willing to learn its principles. What makes income real estate particularly effective as a bank alternative is its unique combination of income and appreciation. Unlike most investments that offer either growth or income, quality rental properties can provide both. Ongoing cash flow that typically exceeds what bank accounts or bonds offer, plus long-term appreciation that has historically outpaced inflation. This dual return potential creates both immediate financial benefit and long-term wealth building that banks simply cannot provide for your cash. I remember working with Patricia, a school teacher who inherited $175,000 and initially placed it in CDs earning minimal interest. After education and careful market research, she invested in a small fourplex in a stable neighborhood. The property generated about $1,600 monthly in net income after all expenses, a cash-on-cash return exceeding 10% annually, while simultaneously appreciating in value as she paid down the mortgage. The bank was paying me less than $200 monthly on my inheritance, she told me. Now I'm earning 8 times that amount while building equity and keeping pace with inflation. The inflation protection aspect of income real estate is particularly valuable in today's environment. Unlike fixed return from bank deposits, rental income has historically kept pace with or exceeded inflation rates. The hard asset value of the property itself provides additional protection, as limited land supply and replacement construction costs typically drive appreciation, at least in line with inflation over long periods. This creates a powerful wealth preservation effect that cash and banks cannot provide. Perhaps most significant are the tax advantages. Real estate investors benefit from depreciation deductions that can shelter much or all their cash flow from taxation, making the effective after-tax return substantially higher than comparable investments. Additional strategies like 1031 exchanges allow deferral capital gains when upgrading properties, while step-up in basis can eliminate capital gains entirely for inherited properties. These advantages can dramatically accelerate wealth building compared to fully taxable bank returns. While direct property ownership requires education and active management or hiring property management, it remains one of the few investment classes where average Americans can utilize responsible leverage and professional management to build significant wealth starting with modest capital. For those seeking more passive approaches, private lending, real estate investment trust REITs, or real estate crowdfunding platforms offer alternative entry points with varying risk-return profiles. Let's explore our fifth powerful bank alternative, which offers both high current income and inflation adjustment. Asset number 5. Short-term private lending. Have you considered that the banking function of lending capital can be performed by individuals, not just institutions? One of the most overlooked alternatives to bank deposits is becoming the bank yourself through short-term private lending. This strategy allows you to capture the lending profit margin that banks traditionally claim, generating returns significantly higher than what banks pay depositors while maintaining relatively high liquidity and capital preservation when properly structured. This approach transforms your capital from passive bank deposits into actively deployed assets, generating substantial income. What makes private lending particularly powerful as a bank alternative is a remarkable yield differential. While banks pay depositors minimal interest, they lend the same capital at much higher rates, capturing the spread as profit. By directly connecting with borrowers in need of capital, private lenders can generate returns of 8 to 12% or more on secured short-term loans, while eliminating the bank as middleman. These returns dramatically outpace traditional cash alternatives, while maintaining reasonable safety through proper collateralization and term structure. I worked with Robert, a retired executive who had grown increasingly frustrated with his bank's negligible interest rates on his $400,000 cash reserves. After educating himself on private lending, he began deploying capital through a series of 6 to 12-month loans secured by real estate with conservative loan-to-value ratios. His portfolio now consistently generates 9 to 10% annual returns paid monthly, turning his formerly stagnant capital into a significant income stream of over $3,000 monthly, while preserving his principal through proper security measures. The key to success in this strategy lies in proper loan structuring and security. Unlike unsecured peer-to-peer lending with higher default rates, sophisticated private lenders focus on short-term loans backed by tangible collateral valued significantly higher than the loan amount, creating a substantial equity cushion against loss. Common security includes real estate, typically at 60 to 70% loan-to-value, business inventory, equipment, or other valuable assets that could be liquidated to recover capital if necessary. This strategy does require specialized knowledge or partnerships with experts who understand proper loan underwriting, documentation, and security procedures. Many successful practitioners work with established private lending firms, attorneys specializing in secure transactions, or experienced real estate investors who have formalized their lending operations. These relationships provide both expertise and deal flow that individuals might find challenging to develop independently. For those seeking more passive implementation, private lending funds offer a professionally managed approach to this strategy. These funds aggregate capital from multiple investors and deploy it across diversified lending opportunities, providing professional underwriting, documentation, servicing, and if necessary, recovery processes. While returns are typically somewhat lower than direct lending to account for management fees, they remain substantially higher than traditional bank alternatives while requiring less direct involvement. Let's examine our sixth powerful option, which offers exceptional transparency and inflation protection. Asset number 6, inflation-protected market baskets. Have you wondered why institutional investors increasingly turn to specialized ETFs rather than bank deposits for their cash management? One of the most innovative alternatives to traditional banking is what I call inflation-protected market baskets, carefully constructed portfolios of exchange-traded funds designed to preserve purchasing power while providing liquidity and modest growth potential. This approach allows you to create a personalized cash alternative tailored to your specific inflation concerns and time horizon, with complete transparency and daily liquidity banks cannot match. What makes this strategy particularly effective is its ability to directly address specific inflation risks through targeted asset allocation. Unlike generic bank deposits that expose you to whatever inflation occurs, these customized portfolios can be precisely calibrated to your concerns, whether that's rising food costs, energy inflation, healthcare expenses, or general consumer price increases. By owning small allocations to ETFs specifically designed to perform well during various inflationary scenarios, you create a protective barrier around your purchasing power. The key to success with this approach lies in proper construction and proportion. The core typically consists of high-quality, short-duration fixed-income ETFs that provide stability and yield, while protected components include carefully chosen allocations to assets with historical inflation protection characteristics. The specific allocation depends on your time horizon, liquidity needs, and risk tolerance, with shorter time frames requiring more conservative structures. What makes this strategy particularly attractive compared to bank deposits is its transparency and control. You can see exactly what you own at all times, adjust allocations as economic conditions change, and access your capital without penalty when needed. The diversification across multiple protective assets provides resilience against various economic scenarios, while the exchange-traded structure offers liquidity similar to individual stocks. For those concerned about complexity, many investment platforms now offer professionally managed asset allocation models specifically designed as cash alternatives with inflation protection features. These models provide professional oversight while maintaining the transparency and liquidity advantages of the underlying exchange-traded fund structure. Regular rebalancing ensures a portfolio maintains its design characteristics as market conditions change. Now, let's explore our seventh and final alternative, which combines multiple advantages in a single powerful strategy. Asset number 7, strategic cash flow annuities. Have you been warned to avoid annuities completely? This overly simplistic advice ignores one of the most powerful cash alternatives available. Carefully selected immediate or short-term deferred annuities structured specifically for income and liquidity. While many annuities deserve their poor reputation due to high fees and confusing terms, certain specialized contracts offer guaranteed income streams, principal protection, and inflation adjustment features that can transform idle cash into secure, productive assets generating substantial cash flow. What makes strategic annuities particularly effective as bank alternatives is their ability to provide income guarantees that no self-directed investment can match. Insurance companies can offer enhanced returns and mortality credits, effectively redistributing assets from those who die earlier than expected to those who live longer. This unique advantage allows properly designed annuity contracts to generate income 2 to 4% higher than traditional fixed income investments with similar safety profiles, creating cash flow substantially exceeding what banks offer on deposits. I work with Margaret, a 68-year-old retired nurse who kept $300,000 in bank CDs earning minimal interest while worrying about outliving her money. After careful analysis, we repositioned $200,000 into a specially designed immediate annuity with inflation adjustment features. This generated guaranteed income of $13,200 annually to start, with increases linked to inflation, effectively more than tripling her previous interest income while adding inflation protection. The remaining $100,000 stayed liquid for emergency needs, creating a balanced approach to her cash management. The key to success with this strategy lies in selecting the right contract type and features for your specific situation. For bank alternative purposes, focus on immediate annuities, which begin paying right away, or short-term deferred annuities, which again pay within 2 to 5 years, rather than long-term accumulation contracts. Look specifically for contracts offering inflation adjustment options, reasonable liquidity provisions, and backed by insurance companies with the highest financial strength ratings. What many critics fail to understand about strategic annuities is their role in creating financial efficiency. By securing guaranteed lifetime income for essential expenses, you can often invest other assets more aggressively for growth, knowing your basic needs are covered regardless of market performance. This coordination between guaranteed and growth assets can actually increase both security and overall portfolio performance compared to traditional approaches. For maximum security, consider spreading large amounts across multiple highly rated insurance companies to stay within State Guarantee Association protection limits, typically $250,000 to $300,000 per company, varying by state. This diversification strategy, combined with selecting only insurers with superior financial strength ratings, creates multiple layers of protection for your income stream. We've explored 7 powerful alternatives to traditional bank deposits: I-bonds offering government-backed inflation protection, precious metals providing time-tested wealth preservation, dividend-paying whole life insurance creating tax-advantaged growth with access, income-producing real estate delivering inflation-protected cash flow, private lending generating substantial secured yields, inflation-protected market baskets offering transparency and customization, and strategic annuities, providing guaranteed lifetime income streams. The fundamental insight I promise to share is this. In today's financial environment, holding significant cash in traditional bank accounts isn't actually playing it safe. It's guaranteeing the slow erosion of your purchasing power while missing opportunities for both protection and growth. True financial security comes not from conventional thinking about safety, but from thoughtfully diversify your wealth across multiple protected positions, each serving specific purposes in your overall financial strategy. Implementing these alternatives doesn't require massive wealth or special connections. It simply requires breaking free from traditional thinking about what cash, and savings should look like. By allocating your capital across several of these alternatives based on your specific needs for liquidity, growth, income, and protection, you create a far more resilient financial position than keeping everything in traditional banking products. As Warren Buffett wisely observed, predicting rain doesn't count, building arcs does. While financial media endlessly debates economic predictions, these 7 strategies allow you to build your financial arc, creating protection against multiple scenarios while positioning your capital productively regardless of what economic weather arrives. If this video has helped you identify powerful alternatives to consider for your own financial positioning, please hit the like button and subscribe to our channel for more practical wisdom about building lasting wealth. I'd love to hear from you. Which of these bank alternatives resonated most with your situation? Share your thoughts in the comments below. Until next time, remember that true financial security doesn't come from following conventional wisdom about keeping your money safe in banks. It comes from understanding the real risks to your wealth and taking intelligent action to protect what you've worked so hard to build.